Hi, everybody. Thank you for joining us today on this beautiful Thursday afternoon. Hope everyone's staying safe and well. It's my absolute pleasure to introduce a couple of wonderful individuals who have been assisting the Geekdom community for the last year or so. Occasionally, um, the people at the people at Shearman and Sterling and Live Oak VP come down from Austin, Texas to visit Geekdom and share their wisdom on venture financing, legal things, startup life in general. And today it's really great to have Cassandra Cuellar join us along with Mason Rath. They're going to walk us through on how to prepare for venture financing. And with that, I will go ahead and pass the buck over to Cassandra to help introduce herself and lead the way.
Thanks, Joyce. Thank you, everyone, for having us. We're really excited to be a part of this and always are excited to support Geekdom. So my name is Cassandra Cuellar. I'm a attorney with Shearman and Sterling out of the Austin office. My practice focuses on representing startup companies at every stage in their life cycle. So from folks that are just getting their company formed to people that are raising money and to companies that are either exiting or preparing for an IPO. And so it's a job I really enjoy, getting to work with founders and entrepreneurs as they are growing their company. And it always comes up with some really interesting questions, and hopefully we'll be able to provide some guidance for those of you that are getting started and are thinking about raising some money. With that, I'll pass it on to Mason.
Hi, everybody. My name is Mason Rathy. I'm with Live Oak Venture Partners. We're based in Austin. Have been coming down to Geekdom and Realco and spending time in San Antonio a decent bit because part of our focus, so we only invest in Texas-based companies. So Austin's a big focus for us because that's where we're based, but Dallas, San Antonio, Houston, we try and spend time in each of those areas. And in regards to San Antonio specifically, we invested in a company last year called Cyber Fortress. So actively try and spend a lot of time there and come in person to things with what you guys are doing. Unfortunately, with everything going on, can't do this in person, but I suppose this should suffice for the time being. So the types of companies that we're investing in, so our fund is a $105 million fund. And with that, our core check size, initial check size is usually in the $1.5 to $4 million range. We're usually leading rounds in the seed and series A range, which can get to a little bit more detail around that in the presentation. Certain opportunities we will dip below that, but usually it's going to be 1.5 to 4 million initially, and then we're life cycle investors, so we'll invest up to 10 million, kind of 10% of our fund over the life of a company as the company goes on to raise bigger rounds, and we continue to take our pro rata or lead rounds as need be. The types of companies that we're investing in is pretty general, so we invest in tech or tech-enabled service businesses. So since we're regionally focused, we do tend to be pretty sector agnostic. With that, I'd say we've had a lot of success in various B2B SaaS type categories, such as digital healthcare. One of our biggest companies is in legal tech, but we've also done a fair amount in the D2C marketplace models as well. We have a company in real estate tech, Homeward, who raised a big round that was announced a month ago. Ojo Labs is a real estate tech platform that announced a raise yesterday and this morning, and they just raised 63 million bucks. So, and then we sold a company, OpCity, in the real estate space about a year and a half ago, 2 years ago. So I'd say in real estate vertical, we've had a lot of success as well. But just in general, we do look at categories across the board. We just like to be that local investor that invests in teams that we can be close to. And part of the value add that we'll bring is the ability to augment the team just through our connections. We've been investing in Texas over the past couple of decades. And then just being the local investor to help with strategy or, kind of act as more of a sounding board than some investors that may be, hundreds of miles away. So with that, I'd say we can jump into the presentation. And we've said it to Joyce and Matt, but everybody feel free to jump in with any questions, highly encourage that. Please do that, just because we can take this in several different directions and zoom through areas that might be more beneficial to you. So happy to spend time on certain categories or anything that is more relatable to you guys and the problems that you're trying to solve today.
Thanks, Mason. So I think where we want to get started today is kind of level setting from a legal standpoint on what companies need to have in place while they're having early discussions with investors, as well as when they're getting started with their funding process. We'll talk a little bit about the early stage investment market and get Mason's take on that. We'll have a discussion about financing instruments by stage. So what I mean by that is explaining what the typical security that would be issued by a company depending on the stage. So for example, a very early stage company might be issuing safes or debt. We'll talk very quickly about some common terms of those early stage investment instruments, and then Mason will have some very valuable information about what you should be doing with your meetings with investors, what investors are going to be looking at, and providing some tips on how to best navigate investor meetings. And Mason, this is the first time we're doing this on Zoom, so bear with us a little bit. Please feel free to jump in on any of the legal aspects, particularly since you're seeing this from the business side on what you think is important for companies to be focused on. We wanted to start off with just discussing a couple of the mistakes that we often see early stage companies making, especially when they're getting geared up to raise money. So very often early stage companies fail to incorporate properly. We generally recommend that companies that are planning on raising institutional money or even money from funds or accelerators incorporate as a Delaware C corporation for a couple of reasons. The main reason being that is the type of company and type of structure that institutional funds are most familiar with and are also more comfortable investing in. We often recommend Delaware versus like the state that they're living in, for like Texas, because Delaware has a very, very well-developed body of corporate law. And C Corps are often the types of corporation structure that institutional investors can invest in. Sometimes some investors will be comfortable investing in LLCs, but I can tell you from experience that doing LLC deals often involve more cost and just more complexities in trying to navigate the tax issues around that.
Have you seen any trends in that going the other direction? So to give some context, we only invest in companies that are Delaware C Corp. So it has to be a C Corp in general, and it always is highly preferable. It's Delaware. We're going through, with one of our companies right now, we're going through the transition from an LLC to a C Corp, and it's certainly causing a bunch of headaches, and it would have been better if this was done early on versus now. But regardless of the fact, it can happen whenever you're getting investment from institutional investors. So it's not going to be a no-go if you happen to be in that status, but ideally you would have done that earlier, at least for us and kind of the other peer funds that I'm familiar with and talk to actively. But Cassandra, have you seen folks getting less, a little bit more relaxed on this, or is it still pretty much the standard?
It depends on the investor, and it depends on what the ultimate goal of the company is. So I have seen some angel investors that are comfortable with investing in an LLC. I very rarely see institutional investors comfortable doing that, with one exception of a deal that we did 2 years ago, which was, very large, huge valuation deal where there were venture investors that were willing to invest in that structure. But I should say that they were willing to do that because the company itself was this big company, had like the backing of a large strategic investor. And that's basically why they decided to do this LLC, because this large strategic investor wanted that structure. And so for those investors to get on board and be able to be part of the deal, I think they were willing to invest in that structure. But 95% of companies will need to be a C Corp. And Mason, to your point, converting a company from an LLC to a C Corp can be easy and it can be achieved, but it does increase the amount of time and the amount of legal costs in order to do that. So generally, startups aren't going to get a huge benefit out of being an LLC to start with, particularly if you know that you're going to be raising institutional money. And I think ultimately ends up costing them more money when you have to actually do this conversion, just because it can be painful. The next item we wanted to cover was properly issuing equity. And there's two parts to that. One is the founder equity that you should initially be granting to your founders. And then two, once that's done, properly issuing employee equity and consultant equity to your service providers in the form of either options or restricted stock. So a couple of things about founders equity. The first thing we wanted to talk about would be vesting. So typically founders equity is subject to vesting. The most typical structure is what you'll often hear as a 1-year cliff and a 4-year vesting period. And so that means that founders have to be with the company for 1 year, and then they would get 25% of their equity vested. And then they would have to continue providing services to the company for the next 3 years, and then they would get monthly vesting after that. And so the question we often get is like, why would we do this? If it's our company, we should just own the stock. Why do we need to have founder vesting? And there's two reasons for that. One is for the founders to protect themselves against each other. When companies first get started, I think founders are very gung-ho and like they're very excited to get going on things, and they trust their founders and they expect that their founders will be around for a long time. But the reality is that having a startup is really tough, and I think people's perceptions of startups can sometimes be a little rosy at the beginning, and it's not going to be that every co-founder is going to be around for the long haul. So founders need to be thoughtful about that and think about what happens if you have two co-founders and one person decides to leave 6 months in. Should that person be able to keep the equity that they got and basically get a free ride as the other person continues to grow the company, right? Like, this is the worst case high school group project scenario that you don't want to be in. So it's important to have that vesting, so that way, if someone does leave to go and pursue other opportunities for whatever reason, that equity can go back to the company, so that way the remaining co-founders can go and find other co-founders to take that place and be able to grow that company. The other reason why having vesting is really important, particularly at the outset, is because that's what investors like Mason are going to expect to see. Investors are going to want to make sure that the co-founders are properly incentivized to stay with the company, and the way they do that is through vesting. And so for our company clients, we often recommend that we just put vesting at the very outset, so that way when you do have like Live Oak or any other investor that wants to come invest, they'll look at that and they'll see how much that founder has vested in, and then they'll be able to have that negotiation with you on like what the proper revesting schedule should be, or if there should even be one. So this is something that gets pretty heavily negotiated, I think, at the Series A round. And it's like, maybe one of the, I would say, 3 or 4 key issues that as company counsel advising the founders that we want to really spend a lot of time and be thoughtful about. Mason, do you have like any thoughts on that you would want to share?
Yeah, so we always do some form, some version of vesting, going through it right now. And then there's a question that came through the chat that I can address in this as well. But whenever we're investing in a company, you want to make sure there's a couple incentives that you want to have aligned As Cassandra's saying, you don't want to necessarily have all the founders, if they own 50% of the company or 60% of the company, and then they leave the company right after we invest and they walk away with all that ownership, then it makes it very complicated to bring in additional talent, because now you have somebody that's no longer invested in the company, no longer has anything, personally invested, no longer with the company, that's walking away with such a big piece. And so that is one of the reasons that you'll do vesting. But you also want to have the main stakeholders, the executives in the company, the founder, the CTO, the head of sales, all the heads of the department and everybody. You want to have them with enough skin in the game that they don't want to just walk away from this either. So like a lot of times whenever we're investing in a company, usually we like to be the first money in, but we're not always going to be the first money in. And some of the times there's been a lot of the company that's been given to various people over the past couple of years because of the stage the company was in, because maybe there was more urgency of needing the capital at that point in time. And then we'll get involved and the founders have very little in the company. And we're actually going through something like this now. And we want our founders to have a hefty piece of the company still, because we want them to be involved, to be as much writing on it, where they want this to succeed and they're not just counting on their salary. They're very much counting on this company to achieve meaningful wealth for them. And so in certain instances, we'll actually even reserve part of the option pool and give the founders additional capital if we're coming into a company and they don't have enough ownership. So one of the first questions that came in, do most investors want ownership? So whenever you're looking at raising funds, there's going to be really two main paths that you can go down. It's either debt or equity. And I guess there's the middle ground of convertible debt. Whenever you're raising equity, you're always giving up ownership in the business. That's what equity essentially is. So that's where you're going to come in with the valuation, whatever cash you're taking, the investor is going to walk away with a certain piece of the company. Not necessarily walk away, but they're going to own a certain piece of the company in exchange for however much capital they're giving you based on a valuation that you guys mutually agree on. The other form of fundraising is going to be debt, where you're not giving up any ownership in your company. You're just, you're agreeing to pay a certain interest rate in exchange for the money. And then you pay back all the principal, all the funds that have been given to you, either amortized over a couple of years, or there'll be a balloon payment for that full sum at the end of whatever agreed upon time. We'll get into it as well, but then there's convertible equity, convertible debt, where it starts as a debt instrument where there's an interest payment, and then at some qualified time, at some set time, like a qualified financing, that debt would actually convert into equity into the new round, which that happens a lot of times whenever we're coming into a company. They may be raising, say they're raising $4 million, but there's $2 million in convertible notes that are outstanding. Those notes would convert into the round with us at the price that we're coming in, or some discount of the price that we're coming in. And so then you wouldn't have debt on your books anymore. You would now just have, you would have the equity all convert into that round. Okay, so there was another question. When do preferred stock get applied? Pre-seed, seed, Series A? Should we offer angels? Comment, do you have example? So usually if you're raising less than like $1 million, usually it's going to be convertible notes. It's just too much trouble to go in and document all the preferred. So I guess there's two reasons for it. One, there's a lot of legal docs that go into preferred rounds. And two, whenever you have a real institutional investor that's coming in, like usually if you're raising less than $1 million, it's probably going to be angels or maybe kind of small family offices, really small funds. Whenever you have an institution that's coming in, they don't want to have a lot of, like a company that we're looking at, they've already had seed preferred shares and Series A preferred shares. So technically we're the Series B, but all those additional capital has been less than $1.5 million. So it would just be a lot cleaner if we were actually preferred seed shares, because at some point you're going to have to clean it up. Like you don't want to get so long in the alphabet before you're a meaningfully revenue generating company. So for, maybe let's skip ahead. Well, we'll get to it in the next slide or so, but just kind of the different investors that you'll look at and the types of funding that they prefer to do and what makes sense. But usually your preferred stock is going to be really at that Series seed type round and later. And then the follow-up question, what's the difference between founder stock, common, and option pool? So founder stock, it's usually, this, Cassandra, you could probably speak to this better than I can, but usually whenever our founders just have common stock. Like some of the times founder stock, you'll hear that term and there's some additional rights that it gives them, but usually it's going to be common stock, and usually that stock is already vested or you're on some type of vesting schedule. Options are usually that's reserved for your employees, and that's always going to be on a vesting schedule as well. But if you
I can add a little bit to this, Mason. So maybe just level set a little bit. The two typical things you hear about are common stock and preferred stock. Common stock you can think about as basically compensation for services. So in other words, sweat equity. That's what your founders would be getting. That's what your employees, consultants, anybody that's providing service to the company would generally receive. There's typically not a difference between founder stock and common stock. I would just say, founder stock, people will just kind of use that nomenclature to refer to common stock. Sometimes, depending on the founding team, some founders can negotiate for themselves, like what you call, super founder stock or super common stock that gives them some additional voting rights. We caution folks about that just because it can make things pretty complicated. Sometimes that's well received by investors, sometimes it's not, but that's really going to depend on the management team. If you've got a team that has been out in Silicon Valley, has had 2 or 3 awesome exits, then yeah, maybe they can have that rights. But if this is your first startup, you don't really have a history yet of being able to take a company from start to exit, then I think investors probably will take a less favorable view of that. And then you had a question about the option pool. So an option is a contractual right to purchase common stock. You'll usually give that to employees and consultants. And so on your capitalization table, it'll just be a reserved number of shares that you can issue out to folks as they come on. Those people will have to basically write a check for the exercise price, which is generally the fair market value of the common stock at the time that the option is granted, in order to actually hold voting common stock shares. And you asked about whether or not you can offer angels common. You can offer angels common. I think more sophisticated angels will recognize that they are better off either taking a convertible debt instrument or a safe and converting alongside the institutional round investors in a preferred stock round, because the preferred stock will have better terms than the common stock. And so you could do that, but I think most angels would prefer to take just another debt instrument. And I should say that it's actually cheaper from a legal cost standpoint to do that versus trying to draft documents for a common stock round. And then example term sheets, there's a couple of different examples that you can look up. So the National Venture Capital Association, NVCA, has a key model documents section on there, and there's a term sheet, and it's actually really helpful. It has basically every possible term that could be in a term sheet under the sun with some helpful footnotes. So you should definitely check that out. And I think Y Combinator has some example term sheets for more earlier stage companies. And then the last question, what is the software of choice for managing and reviewing the cap table? that's my preference. I think there's another one out there called CapShare, but I think Carta is just easier to use, and I think it's just been adopted by more people, and I think VCs are more familiar with Carta than other programs out there. The other alternative is just a good old Excel spreadsheet, but that can sometimes get a little wonky if you don't have someone that's constantly keeping it up.
Yeah, our companies, by the time we come in, usually they're on Carta.
Yeah. Okay. Well, feel free to keep on sending us questions our way. We're monitoring the chat, but we'll just kind of continue plowing through this. So we talked a little bit about, founders vesting, properly issuing employee options. So the things I'll say there is that anytime you're going to issue equity, you need to generally have a board consent or a board approval approving the issuance of that equity. And for options, it's important that the board approves a strike price equal to the fair market value of the common stock of the company. And the reason why that's important is because there is a regulation out there called Section 409A under the IRS code that requires that strike pricing to be issued at the fair market value. And so before the company has like an actual price round, the fair market value is usually, par value or some really de minimis value that the company will decide. After there is a Series A round, we recommend that companies go get 409A valuations, and you can actually get that through Carta now. So, maybe one other reason to just get on Carta as soon as possible, because Carta can provide that for you. On compliance with securities laws, very often for particularly first-time founders, we run into issues here. So it's really important when you're raising money from people that you raise money from accredited investors. An accredited investor is generally a pretty well-off individual, someone that has a net worth over $1 million or has made, I believe it's $250,000 in salary over the past 2 years. And so for better or worse, that really can narrow down who you can approach for investment. Like, for example, I could not go and ask my grandmother for an investment because she's not an accredited investor, and you shouldn't do that as well. You should just always keep in mind that these are still really risky investments for people, and if someone doesn't have, the financial wherewithal to really stick with it, then you're probably not doing them any favors and getting them involved really early on, even if they really want to help. And there are securities laws to regulate that. And it's really problematic for companies that have unaccredited investors on their cap table that, from a legal perspective, we'll just have to figure out how to deal with that. The other thing that I just want to keep in mind here is that for companies, some companies will probably have all kinds of people that want to offer help for equity. Like, you should just be really aware about that. Generally, if someone is going to get equity for helping you raise money, they need to be a registered broker under the securities laws. And you'll just be amazed by how many people just say, like, well, I want to introduce you to X, Y, and Z, and if they raise money for you, I want to get, this percentage of the company. That should really raise some red flags for you, and you need to do a little bit more due diligence about that. The reason why is because if you do use that person and you do compensate them, there's a securities law issue there where the investors that came through that person could actually rescind their investment. And so you're not going to have money to pay back those people if they all of a sudden, get annoyed with you and they want their money back. So that can be a pretty significant issue. The next point is protecting intellectual property. I can't overstate how important this is for early stage companies. Every single person that is providing services to your company needs to sign an agreement assigning the IP to the company. This goes from, your founders. This is like any employee, any consultant, basically anyone that is providing any service needs to sign an agreement with you. A lot of times where companies get sideways on this is if they have like somebody that was just there for a short time, or maybe they hired like an intern to do some marketing for them, something that's like really not material to the company, and they just didn't get it signed just because you have a lot going on. That ends up being very problematic, because when you have a investor or an acquirer that wants to purchase the company, that's the first question they ask. They want to make sure that there is an agreement for every person that's ever worked for the company ever. And if you have gaps, you have to disclose that to them. And it can become an issue where your investor asks you to go back and get signatures from those people. And so that's an administrative headache. And then a lot of times those people have their hands out and want to get more money because they know that they've got you over a barrel, basically. But more fundamentally, you want to make sure that your company that you're growing actually owns the IP that it's purporting to own. Because if you don't have ownership to your IP, then you really don't have anything in your company. One thing to just keep in mind is if you're hiring people in certain states like California, a lot of the form agreements out there will have like non-competes and other things like that in there. And so you have to be very thoughtful about that, because like California, for example, if you've got a non-compete in your PIIA, that can actually invalidate the entire PIIA. I think if anyone watches Silicon Valley on HBO, like this was basically the whole first season. And if you haven't watched that show, you probably should. It's probably pretty helpful for you guys. Mason, you might have a very strong opinion on this point.
Yeah, I mean, I think that everything that you're saying is certainly pretty spot on with the way that we think about things. I mean, we've worked with Shearman and Sterling on a lot of this stuff. So yeah, I mean, I can only agree with what you're saying, and adverse to it, it creates a lot of sticky situations that I wouldn't say necessarily that we would like walk away from a deal if that stuff isn't documented spot on, but it creates a lot of hair, and there's the possibility that a deal could fall apart because of it. So.
Yeah, there's a couple of questions on the chat that I'll get to in a second, but I will just say from my experience, when we're doing, early stage, we're representing early stage companies, we spend so much time on this, on the disclosure schedules and having discussions with investors. And so you just have to keep in mind that, time is money, like particularly for lawyers, because you're paying them by the hour very often. And so to the extent that you can reduce time that your lawyers or that you are having to have discussions like this by just having, good corporate hygiene and getting agreements signed up, the less money you're going to have to pay for them and the less headache you'll have to do. Okay, I'll go through some of these questions here. So the first one is, does the discussion about accredited investors apply equally to LLCs or just C Corps? It does apply equally to LLCs or C Corps. Frankly, it applies to basically any time that you are giving someone a piece of ownership in your company. So, and I should just say that it doesn't apply only to actual common stock or preferred stock shares. If you are issuing safes or you're issuing convertible debt, that's also considered an equity instrument. And so you should just be issuing those out to accredited investors. Okay, next one is, from a tax perspective, how are convertible notes, safes, and venture funding taxed, if any? Well, I think it probably depends on what perspective. Like, there's not going to be tax from the company side if you're, selling equity to any of those instruments. And generally, there's not going to be like a taxable event until the notes or the safes or the equity that's purchased in the venture funding is cashed out. So that's generally going to be something that will come up in an exit event. Then the last one is, if each founder has an equal capital contribution, how can you ensure each founder still puts in the sweat equity through a vesting agreement if they have all equally purchased equity? So there's like a legal response here, and then there's a more business response. I think, let's start with the business response. You have to really trust the people that you are giving equity and your co-founders. And so if you have any kind of concerned that someone's not going to be able to pull their weight, you should really price that into whether or not that person should have an equal contribution. So let me give you guys like a real life example of where I've seen this, where we have like two founders. One person is clearly the person that is, driving the company. She's the person I'm having phone calls with. She's the person like that is providing all the information for me, is putting, dollars up and everything like that. And her co-founder that she has chosen is someone that doesn't really have a technical background, is like, I think she, if I remember correctly, and I don't want to be disparaging of Pilates instructors, but she's a Pilates instructor. So she just clearly like had other things that she wanted to be doing and not focused on providing services related to the company. So like that was an instance where we had a lot of discussion about what was a proper distribution of the equity between the two co-founders. And my advice there was that she should be really careful about that. She initially wanted to do 50-50, but you have to take a pretty hard look at your co-founder and figure out whether that co-founder actually has the time and the efforts to be able to put in 50% of the work. That's kind of at the outset. There's not really a great like mechanism to ensure someone is going to put enough equity. It's like enough sweat equity into something. It's really just a conversation you have to have with your co-founder. And if at some point that person's not working out, then you need to have that conversation with them, and they might need to resign from the company. And that's when your vesting kicks in. So if someone were to really just not be providing any help in the first year, then that person wouldn't get anything. But if like that conversation happens a year and a half in, then they've like already vested. So my advice to founders is always to have those discussions early on and be very honest with other co-founders. So that way, if it's clear that someone is just not working out, the earlier you have that conversation, have that person move on, the better it will be.
Yeah. On that one, do you generally see, so we don't generally see like a vesting schedule until, I mean, I don't know what I guess you could still have it, but you don't see a vesting schedule until an institutional investor really comes in. And so, yeah, I mean, in the beginning, that's a conversation between the founders on who owns what, and maybe somebody's contributing more capital, but another one's contributing more time. And so you should certainly take that into account whenever setting up the initial cap table for the business. But whenever we're coming in, that's whenever you would be put on a vesting schedule. It's right now it would be each owner owns 50%. But whenever we're coming in, and usually we're coming in and we'll do $2 million for 20% of the company. So $10 million post-money valuation. That's whenever we would put both of you guys, your 40% would go on a vesting schedule. So it's not necessarily like to the point that came up is like, even though they've equally purchased equity, that stuff is kind of doesn't really have as much weight until you have an institutional investor coming in. And so it's not necessarily, you're not looking at it as like purchased equity. Then some of the times maybe a founder may invest alongside and actually try and get some preferred shares. And preferred shares, I can't think of an instance, and it wouldn't necessarily make sense, of when those would be on a vesting schedule. So maybe the one of the founders, somebody, if they're actually contributing money along any of the preferred rounds, that's not going to be on a vesting schedule, because you're right, that is purchased equity. But all the common stock that was set up initially, that would go into a vesting schedule. So like I said, just to reiterate, it would be based on capital contribution, the amount of time that somebody's going to be spending on the company. Those are going to be the main things that you probably set up early on whenever you set up ownership. But whenever we come in, if it seems like the ownership isn't where it should be with one founder versus another, there's various ways that you can kind of even things out, if that's what, depending on what the board wants. An investor coming in, maybe we have one board seat and the two founders have another board seat, so it'd still be need to be agreed upon. But there's ways of evening things out in each subsequent round of financing as as more contribution is performed by various people. What is the next question?
There's one, I think, kind of legal question. So the question is regarding IP protection and non-compete valid in Texas. Yes, they are valid in Texas. Generally, they will uphold, the courts uphold non-competes for up to 2 years. If you've got something longer than that, that's problematic. But 1 to 2 years is reasonable. California is the main one. I think Illinois has some like weird concept about it, and I frankly couldn't tell you because it's been years since I've had to do an Illinois non-compete. You kind of just have to do a state-by-state analysis. Most people that I've seen are either going to be here in Texas or in California, though. Should you be specific in the operating agreement under which circumstances an equal partner would not receive their equity, even if they theoretically put in equal cash? I'm not sure I quite understand this question. So generally the way the equity would work is you would just issue it out to everyone, and so they would own it. I guess you could put in, particular like vesting, like they have to meet some kind of milestones in order to be able to keep their equity. You could write that into their purchase agreement. And then just wanted to clarify one thing: if they theoretically put in cash, so cash investments are not subject to vesting, just on a general note. Really, it's just equity that you're purchasing with effort. And can the responsibilities of the founders be tied to their equity regardless of equal capital contribution? The responsibilities of the founders just gets negotiated, and sometimes it reflects what the equity distribution is, but then sometimes it doesn't. So I think that's just something that the founders have to have an ongoing conversation about. It's really hard to put that in an agreement, unfortunately, just because people are going to have different personalities and different work ethics.
So I know we have a stop at 1:30. There's 2 slides that I briefly wanted to touch on. Cassandra, do you mind?
Mm-hmm.
And then we can circulate this, let's stop on this one. Go back one. We can circulate this deck and y'all can follow up. We'll give you our contact information. You can follow up with any questions afterwards. But just to be conscious of time, and a couple of areas that I wanted to hit. Just as you're thinking about fundraising, there's kind of 2 components that at least come to mind right now that you want to think about, and it's making sure you're approaching the right folks and making sure you have the right stuff in the deck, that whenever you approach these folks, the deck's going to be answering a lot of the questions that they would be asking. It's always better to have the data prepared ahead of time versus trying to answer it on the fly. It can always get you in a sticky situation. So whenever you're raising your initial round of funding, that's usually, the friends and family round, where you're going to go to people that know you well, people that, maybe have a little bit of insight into the problem that you're solving, that are still very much within your network, that believe in you. That's usually going to be what kind of gets you off the ground from that ideation phase. So that's still, very much whenever you have a good idea and you're trying to just develop the initial product. Institutional investors like us, so we would fall into this. It's actually not this slide, but usually whenever we're investing, it's going to be post revenue. So whenever we're investing, I would say that it's funds in our size range. So we're a $105 million fund, but it'd probably be the funds that are like 60 million to 250 million or so. They want you to have what can be described as like initial evidence of product market fit. So you have the problem very clearly defined, you have a solution defined, but now you actually have people that are willing to pay for the solution. You have validation from the market that customers are willing to pay X amount to solve the problem that you're trying to solve. So then it's real world validation that this solution is valuable, 1, and 2, it helps to give some more insight on who is the customer persona that you're targeting, how many of those are in the United States, and kind of the multiplication of the 2 would give you a bottoms up market size, which is something that we're always we're always looking to calculate whenever we're making an investment. So on this slide, you have kind of who some of the funding sources are going to be as the company grows. And I'd say that monthly revenue row is that's not going to be stark black lines that define borders that define each of those categories. Like we will do certain pre-revenue opportunities, but this is probably generally what you're going to find for the investors. And then just one other slide that I wanted to touch on. Cassandra, do you mind? Next, please. So here's back there, actually. So this one, go back to one more. So this one would be one forward. I think it's a little lagging. This one would kind of give, the breakdown of the different types of investors that you would be targeting as the company's growing. And I think that, the value add is pretty spot on. Usually angels, they're investing in the idea, but maybe they're not giving you it's more passive money. Some of the times you can actually get some advisors that are very much helping you develop the product. Usually they may even be rewarded in stock, even if they're not investing in the company, just because, some of that feedback that they can give you is worth more than cash that you could give. So our fund, part of our value add that we'll do is, since we only invest in Texas companies, very much we like to kind of build the talent around the team. So whenever we invest in companies, usually there's going to be certain gaps within the executive team. So we have a broad network within Texas, so we'll certainly help there. And then we can, we've had a very strong track record of helping to build large businesses. So, through helping you with the data or any type of gaps that you have in trying to scale the business through, your go-to-market initiatives, your customer acquisition strategies, just helping along those lines and really helping to identify your ideal customer persona and how to obtain those and how that may change as you develop more product. And so trying to act as a sounding board and really help along those lines or where we like to say that we can help a business out a lot. So those are, I just wanted to make sure to get those. There was another slide in there, but I don't know if we're gonna have enough time to hit it, but if there was any of these that you wanted to get to.
I think, Mason, that this is probably like really key. I think you should spend some time on this slide and the next slide.
Yeah, this was gonna be the last one I wanted to get to in just with a couple minutes here. So as you're trying to approach investors, folks around Texas, I think, are pretty open to meetings. Like even, me or other folks like that are at the stage funds that I'm in are pretty open to being introduced to people. And so you should always try and find, to the first point here, you should always try and find a warm introduction whenever you're trying to meet an investor. If you look around LinkedIn, I would assume without a doubt, as you're in the tech community, you can find somebody that knows an investor in a various kind of ballpark of who you're targeting. So that's always the best way to get the attention, because one, that's just, if it's a friend of mine that introduces you, it's going to move to the top of my emails versus, getting to it at some point in time. And two, it shows the resourcefulness of the entrepreneur, that they're able to find connections. That shows, like, for customers that you're trying to get in front of, for investors down the line, just being able to find ways into the people and groups that you're trying to talk to is always a positive sign. A lot of times we like to actually be in touch with the companies that we potentially invest in prior to investing in them, just because it helps to develop a little bit of a track record with knowing them and their credibility on saying that these are the goals that a company is setting out to do, and seeing them actually achieve those goals. That's very solid history that we can certainly get behind, but that doesn't always have to be the case. It's rare that right whenever you're looking to raise a round is the exact time that makes sense for us. So there's no harm in, like, whenever you're putting together your deck and thinking about reaching out to investors, you don't have to wait to the exact opportune time, because then it could easily miss people's schedules. So just, talking to them sooner rather than later, and building that relationship is always a positive. Be prepared with materials. So that's where I want to talk about the pitch deck for a second. So that's that blue box that's over here. I think that this does a decent job of laying out the different things that we like to look for. I want to put special focus on that market size. That was something that I mentioned earlier. You'll always turn off investors if you do one of those, TAM, SAM, SOM market sizes, and you have numbers that are in the several billions, because this is what IT spend is in a certain category. That doesn't give a market size of what the revenue potential is for you. You're not going to obtain, if various spend in a particular, on IT products in these industries equals that, well, a lot of that spend goes to other products that you're not solving. And so the best way for market size that we always encourage is, what do you think? Maybe right now you're doing penetration pricing, so your average contract value is less than what it will be once you get to more of a steady state. So you can take that into account, but I would note that is like our average contract size right now is 20K, but we think we can get it up to 100K. And then there's there's X number of customers that we can target with that. So that creates a market size of Y. That's always something that we're looking for. Competition, yeah, you always want to be prepared with the competition, just because there's a possibility we've seen a deal similar in the space. And if we bring up a competitor that you're not aware of, that's not a good sign. So, maybe you have the competition in there, and maybe they're better than you at certain things, but maybe you've developed a very particular set of skills that you're a lot better than them in this particular spot. Whenever we're investing in companies, it's also good that you're not trying to be everything for everyone and trying to solve all these different problems at once. If you can solve one problem much better than the others and really be the best of breed, even if it is a point solution, that there's a lot of companies and examples that you can point to that have succeeded with those types of models. So I'd rather you be the best of breed at one thing than a jack of all trades and not necessarily category winning in 10 different things. And then whenever you're in the meetings, it's, some of the times investors can rub you the wrong way, and it's always just, take the feedback. You don't have to incorporate everybody's feedback, especially as you do a bunch of pitch meetings. Everybody's going to try and give you their 2 cents after spending 30 minutes with you, or maybe you spend an hour and a half with you, but listen to the feedback and don't be defensive about their questions. If they're not understanding something that should be obvious, then maybe you just need to do a better job of articulating it, or trying to paint the picture, or having analogies that make sense. And so, if somebody ever gets defensive, then it's just kind of red flags of being able to work with this person over the long term. So take the feedback. You don't necessarily need to incorporate it all, or else, it goes back to you're trying to solve everything for everybody. And that's, so it's take the feedback, but you guys started the business for a reason. So you should also trust your intuition there, while making sure it's kind of based on data. Another point with this is always knowing your data super well. Like a lot of times in meetings, we'll actually get into some detailed conversations about how certain customer contracts have grown, or what your funnel metrics look like. And so the more you know that data, and even if you need to pull up a spreadsheet in the meeting, that's completely fine, because the more that you know that and can handle those questions on the fly, versus giving the answer, let me get back to you, just creates the opportunity for the conversation to still very much end with an outcome that you're wanting. But if that's not the case, still, if you don't know an answer, it's better to say, let me get back to you on that, and be honest, than to try and bullshit around the answer, because that a lot of times investors could see through that, and then it's a red flag on the founder, which whenever we're looking at investments, it's always going to be founder first, making sure it's an interesting market opportunity, but very much the bet is on the founder, because they're the ones that we're anticipating is going to grow this business from, 10K a month in revenue to, 20 million a year plus. So long-winded on a lot of that stuff, but I know we we don't have a whole lot of time here. So I think we had till 1:30. If Cassandra, if you want to hit any other points, I think I just got a lot of the topics that I wanted to talk about. And if there's any other questions that come up after this, happy to answer them via email. Joyce and Matt can send you our email addresses.
I'm happy to stick on for a few minutes. We want to answer these last two questions. I know others probably have a hard stop at 1:30. Joyce, whatever works for you.
Yeah, I think that's fine. Actually, you know, we always want to make sure that we can get the information to the people who are watching and tuning in. And so if you have a couple minutes to answer these last two questions, I think the rest of the audience would also appreciate it. And for sure, I will be able to get anybody who wants to be connected to either Cassandra or Mason. I'm going to drop in a good email for people to reach out to Geekdom at, and then just we'll follow up after the presentation.
Thanks, Joyce. All right, two questions that we've received through the chat. So the first is, when a VC invests in seed round, how does the board grow? Does the investor take 2 board seats, and is an advisor added to even out the board? So generally speaking, the board is one of the most highly negotiated parts of a VC transaction. For a early stage round, what we typically see is a 3-person board, and so that can be 2 common, 1 VC, 1 common, 1 VC, 1 independent director. So really it can kind of be all kinds of different variations on that. What we don't recommend for companies is having too big of a board, particularly if you are raising just your very first round. I think 5 people at a first round is too big. And the reason why I say that is that, you know, the board actually plays a pretty important role in management of the company. And so anything that, you know, the company needs to do is going to require consent from those board members, or you need to get those people on board. And so the larger your board, the more people that you have to go and ask for things from. And I can just tell you from experience, a lot of the people that serve on boards, they like to take vacations when you absolutely need them to sign something. And so like DocuSign helps with that, but it's just hard. So generally you want to keep your board pretty tight, and you want to make sure that you have good relationships with your board members to the extent you can. And just make sure that there's a lot of communication with your board members as you're doing that. Let's see. And the second question, the last question, is that whether or not it made sense to incorporate in Nevada versus Delaware. In the past couple of years, Nevada has tried to basically mirror Delaware law to be a potential home for companies. I don't really see what the marginal benefit for incorporating in Nevada over Delaware is. You should just go with Delaware and just not have that conversation. I feel like any kind of cost savings you might have with incorporating in Delaware is just going to be immediately negated by having the conversation about why you're in Nevada versus Delaware. So just do Delaware. Last call for questions. Anybody else have a question for me or for Mason?
I'm just giving it a second.
Okay.
Well, this has been great. And like we said, you know, happy to answer any questions or hop on a call after the fact. At some point would be great to see y'all in person. It's, you know, a little less personable whenever we're doing the presentation, looking at our slides versus looking at you guys. So, yeah, looking forward to being able to come down to San Antonio soon.
Awesome. No, thank you guys so much. You know, it's always a pleasure getting to collaborate with, you know, your organizations. We get a lot of value out of it, and we love the fact that you're willing to get plugged into what's happening here in San Antonio. I have given any of the people watching a good email address at Geekdom, and I'll connect anybody up who would like to speak with you further. I wish we could give you more of a round of applause, but this was fantastic. We look forward to the next one. Everybody, thank you so much for tuning in. Definitely reach out to Geekdom if you want to know more information about anything else that we've got coming up. Our Datathon applications closed today, so in the next few weeks, we're going to have a couple of Datathon teams working on the Smart SA Datathon Open Data Competition with CivTech SA. If you have any questions about that, you can also email info@geekdom.com. We're happy to connect you up for those things as well. With that, everybody have a fantastic rest of your Thursday, and we'll see you soon.
Thanks everyone.
Bye-bye.